How's it going?
It's going good. Can you hear this?
Yeah, you sound kind of weird when you talk like that.
Oh, okay.
The audio's coming in okay.
Great.
Just the tone of voice.
This?
There we go.
Let's go.
All right. Welcome to another episode of Map Your Money. I'm one of your co-hosts, Arish and joined by Jeff Cohn. How's it going today, Jeff?
Going pretty decent. Can't complain. How you doing?
Good. I feel like this is going to be coming out right around end of October, and so hope it's cooled down. I've been waiting for this fall weather for so long now, but it's still miserably hot here in Georgia. But my icebreaker for today is, what is your favorite spooky activity? So like Halloween themed, carving pumpkins, going to a haunted house, watching horror movies. What's your October vibe, Jeff?
That's a good, I love, being under some blankets, having the windows open, feeling that cold air coming through the window, candles burning, dog and girl right beside me watching the creepy movie. That's pretty awesome. But when I was in college, we used to go to this haunted house that was like a collection of haunted houses in this one cornfield. And we would always get like a big group of us to go out there and like go through like these huge like outdoor mazes with just these random people coming around and like screaming at you and following you around and stuff. And you get a big group, and there's always people that are a little more afraid than they should be, right? So I think that's probably it, man. Going to those places, just kind of seeing it, like seeing the creativity. And so, I'm like always the nerd that's like in the haunted house, like, wow, how did you do that? Oh, hey, how are you? And I'm moving on.
I used to love the haunted houses. I feel like I'm at a weird in-between age right now. I wanna get back on them, but I remember vividly this one memory. I also probably go to a haunted house this year. Like, I'm not discounting that by any means, but I remember this one memory of me and like 6 of my guy friends in middle school. We go to Netherworld, which is like this like really coveted. If the listeners from Georgia, they'll know about it. Really big haunted house in Atlanta. And like, this was our first time going. We heard all this hype. We're walking in, and there's this like maze of mirrors right before the line. There's no one in the maze of mirrors. It's literally just like you're going through the maze of mirrors, and there's no one in it. It's just to get into the line. But we were screaming like crazy going through it, seeing ourselves. And then we get out into this lobby of a bunch of people waiting in line in a well-lit room, and they're all like, "Oh, what are y'all screaming about?"
Y'all, it hasn't started yet.
Yeah, it was a tough start. Needless to say, the rest got to us pretty bad too. But,
hey, we're looking forward to it here. We're going as cone heads, I think. Like Beldar cone head.
I like it. Heck yeah.
See how it goes. It's not quite as good as my best costume, which was Ace Ventura back in the day, but maybe I'll revisit that one day.
I know we usually post something about people's costumes, so we'll see how you match up to the rest of the team.
All right, can't wait.
But good. It's an awesome time of year. Definitely love the vibes of October, but have an awesome episode for you guys today. So let's get into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and help individuals create the roadmap for their financial future. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the content was pre-recorded.
All right, so we're going to be switching up the format. It's kind of the same format, but switching up a little bit of what we're doing on the back end. And so basically every episode going forward, we're going to talk about one investment market econ topic that Jeff is going to lead, and then one financial planning topic that I'm going to lead. Jeff, so you want to kick it out first? You want to start with planning first? You tell me.
Yeah, do planning. What you got for us, Arsh? I'm going to hog the time on the back end anyway.
I could probably talk about this topic for a while, so I'm going to try to keep it shorter, but basically want to talk about the taxation of different assets and how you should recognize how these different types of accounts and different assets, more importantly, get taxed. And so I know I've spent a little bit of time in the past talking about the taxation of different accounts. So like a brokerage account gets taxed in a certain way versus a Roth account versus a traditional IRA. I wanted to more talk about the underlying investments and how those get taxed. And so there's two main forms of taxation, ordinary income tax and then long-term capital gains tax. And so for the purpose of this, let's assume all of these things are in a brokerage account. And some of these that I'm going to talk about can't be in a brokerage account, but I'll explain that as well. And so as far as things that get taxed at ordinary income, you can think of your checking account, you can think of a high yield savings account, money market account, bond interest that you get, and dividends. I think those are the big five there in terms of what gets taxed at ordinary income. Real estate income, now that I'm thinking of that as well. Anything else I'm missing here, Jeff? Off the top of your head?
I'm going to trust you.
The majority.
Yeah.
Okay. I think that's the big ones. And so for each of those, whether you're getting that really tiny interest on your checking account, whether you're getting a slightly higher interest on a high yield savings or even more on a money market, whether you're getting rental income from real estate or whether you're getting bond interest or a dividend, all of these are taxed at your ordinary income rate. So let's say you're making $150,000 a year. We'll put this on the screen in terms of the 2024 tax brackets. But based off of where you're at with tax brackets, so let's say 250,000 married filing jointly, you guys would be at the 24% tax bracket. And so if interest from your bank account, you made $10,000 in a year, 24% of that would be taxed, aka $2,400. In that sense would be going to the tax man and to Uncle Sam. And so that's the ordinary income side of things on the one hand, and then there's the long-term capital gains tax on the other. And so if you hold a stock, for example, for a year or longer, and then you sell that stock, then you get to pay, if you had a gain on it, long-term capital gains. So let's say you bought Apple for $100. It's been over a year and there's been a crazy uptick in Apple. Maybe NVIDIA was a better example for this, but let's
Apple's
say it's up to 250. Okay. They've had a good year. Yeah. They've had a good year. So let's say you bought it way back when. Now you're selling it. You have a $150 gain. You have to then pay long-term capital gains at that. And so the big point of me talking about this is to explain that long-term capital gains is always going to be at a lower rate than your ordinary income. And so I mentioned that example of you having, what I say, 5,000 of bank interest.
Wasn't it 10,000?
Whatever number I said.
I think it was 10,000.
10,000. 10,000. If you had 10,000 of that bank interest, you're having to pay at $250K, married filing jointly, obviously, wherever you're at on the income scale, you're paying 24% there. If you had 10,000 of appreciation in a stock that you're taking, or that gain in a stock, married filing jointly, that same income, you only have to pay 15% tax on that. And so it's an advantage compared to ordinary income rates to have that long-term capital gains rate. This is a throwback to a really, really old episode when we had Garrett on and talked about ESOP and the kind of benefit of moving that money into a brokerage account. But this is kind of why that makes sense, is you don't want to take that out of your IRA where you have to pay ordinary income tax when you can have the benefit of paying that long-term capital gains rate at a lower rate. And so stocks, you're going to pay that appreciation. You're going to pay that long-term capital gains. Real estate appreciation on a secondary or another form of home as well. Technically your primary residence as well. But you have that primary exclusion on that, which will usually cover a huge portion of that gain that you might have. We can talk about that in another episode as well. And then commodities are a little bit different. They're also taxed at capital gains, but they're at a slightly higher capital gains rate. And so they're at 28%, I believe. But I think it's just important to understand the different ways that different assets get taxed.
Yeah, I think that's That's a great discussion there. And can you like dive in a little bit on a concept that I know, tax time is going to be coming around the corner here soon. A lot of people confuse effective tax rates with marginal tax rates. You like clear that up for us?
Definitely. And so let's stick with that 250,000 example. So we'll put that back on the screen in terms of the tax brackets here. We see that your marginal tax rate is 24%. And so that means the last dollars that you're making, basically, if we're looking at this example, from 201,000 to 250,000, all of that's being taxed at 24%. But that money before that, from 94,000 to 201, is actually being taxed at 22. From 23,000 to 94 is at 12, and above that's at 10%. And so your marginal rate is blending all of those together and saying, this first 23,000 times 0.1, this next 70,000 times 0.12, and then adding each of those up and saying, okay, based off 250,000, your effective tax rate, or that last tax that you're paying the marginal tax rate is going to be that 24%, but your effective tax rate is actually lower than that because you're taking advantage of those tax rates above you as well.
The effective tax rate, kind of like your average that you pay for like all of your income versus your marginal tax rates, the tax rate you pay on your next dollar of income.
If I could have just said it that concisely, I would have, but that's why we're here.
You're here for the details, man. I'm here to back you up.
There we go. Love it. Yeah, no, that's a great explanation. And I think another thing that we can talk about in a future episode as well is tax equivalent yield. And that's kind of going to when you're at a higher tax bracket, does it make sense to maybe not pay ordinary income on a money market fund and maybe get a muni money market fund or a MMMF? However many M's that is. We were just talking about that.
MMMM.
There you go.
The muni money market fund.
Yeah. Simple.
Yeah. Well, tax equivalent yield, maybe. I mean, it sounds like we need to talk about it now, right? I mean, it's I think it's a really cool concept. I mean, you're talking about tax rates, a really cool concept, right? So like muni bonds are not taxed on the federal and state level, right? And so because of that, investors know that. And so they're willing to accept lower levels of yield on that bond, even if it's the equivalent, risk as say like a similar corporate bond, right? And so what they'll do is they'll kind of find the adjustment, right? Like where is the interest rate on a muni bond that will give me the same after-tax yield as that equivalent corporate or treasury bond, right? And then that's what they consider that muni tax equivalent, where you're kind of equaling out the after-tax return. And so obviously, if you have to pay tax on interest, then you're going to need, a little bit higher interest rate to pay that tax plus have that after-tax rate of return left over if you're comparing with the muni, which doesn't have to pay that tax at all, so it can start at that lower rate, right? So I think that's something that, for us is pretty important. Obviously, we pay a lot of attention when trading and non-qualified accounts to, long-term versus short-term taxable gains, but we also pay attention to muni bonds and whether or not, depending on a client's marginal tax rate, if having that, next dollar not taxed at a high rate is maybe more advantageous than buying a taxable bond and then paying that tax on the interest.
Definitely. I think it's important to recognize that. So munis, just to summarize what you said, the munis, whether it's a muni money market fund, a muni bond, it's federally tax exempt. And you're most likely going to be getting a worse rate on paper. So if you're looking at a 10-year treasury bond versus a 10-year muni bond, the muni is going to be a worse rate on paper, but the whole benefit is that after-tax yield and say, okay, I'm in the top tax bracket. I'm in that 37 or even the 35% bracket. After tax, my tax equivalent yield would actually be better if I did the muni and took that discount on the front end, because I don't have to pay that tax on such a higher rate on the back end.
That's right. With the added benefit of you're not giving Uncle Sam your money. Love it.
Exactly. And that's one thing we're trying to avoid here in our planning, and give strategy on making sure you're utilizing the different accounts and the different ways of treating assets to maximize your return after tax as well. I think it's a massive point there that people often overlook. They get too glued in on whatever number percent and don't kind of pay attention to the number after they pay their taxes, which ultimately that's the money going into your pocket or your bank account or the appreciation you're seeing. So
that's right.
Really important to recognize that as well.
Good calls. I guess it's time for us to talk about all these interest rates then, huh?
Let's flip it to the Fed.
Let's flip it. All right. So my segment, really cool stuff going on, Arish. Tell me if you heard about this story. A couple of weeks ago, the Federal Reserve cut interest rates. Did you hear about that?
I did hear about that one, yes.
It came up, huh? Sweet. So this is really strange in that they're starting off this interest rate cutting cycle with a 50 basis point interest rate cut, right? So the Fed funds rate, they target it at a range. So it's 5.25% to 5.5%, and then they cut it 50 basis points. So now it's at 4.75% to 5%, right? Now, what's really cool about this is really the first of a series of rate cuts that we're going to get in, the next few Fed meetings. And so the Fed meets about every 8 weeks. They just met in September. They're not going to meet in October, but they are going to meet in November and December. And then they have a few meetings next year going into May. Right now, priced into markets, it's priced in that the Fed is going to cut interest rates by 25 basis points at each of those next few meetings, right? So I think, really kind of keep people updated. Hey, the Fed has started this cycle of, hey, interest rates are too high and we need to get interest rates back down to what we consider a more normal level. They're starting that off pretty quickly with 50 basis points. It looks like they're going to follow it up about 25 in the next few meetings here.
Yeah, and I know we've talked about this a couple different times, starting to kind of feel like a broken record to an extent, but it might just be because it's what we do every day. And I explain it to clients, you explain it to all of us. But the reason that the Fed is looking to cut, you mentioned that rates are unnaturally high. But the economy has continued to be good, and we've moderated inflation to a much more sustainable level. And so now they believe we're in a good spot to kind of bring these rates down, and wanted to kind of talk about that point a little bit more, that the economy has been good. I know we got a really good jobs report recently. I don't think we've talked about this together. I know you probably sent us a message, but I saw this on my morning brew.
So it's over the last couple of weeks, economic sentiment has actually improved quite a bit. Part of it is the jobs report that was released last Friday. So we're recording now on October 8th. So this was released, it's the first Friday of every month. And really there was a lot of kind of positive boxes checked in that report. The payroll growth was really good. Wage growth was really good. The household survey, which includes like employment and unemployment statistics, all of those improved. Participation rates look good. So really this report was a sign that, hey, some of the worries that you've had about the labor market may be misplaced. And then the day before, it was a week before that, we got something that was really kind of unique. We got revisions to our GDP data for the last 5 years. And so, what happened was as we compile the data for GDP, there's a lot of assumptions and estimates that have to be used. But as time goes by, we have a lot more kind of hard data to base this number on. We can have a kind of more reliable estimate, right? We actually increased our estimate of GDP growth in 2019 through the years 2023 by an average of about 0.4 to 0.5% a year, right? And so what this did is it increased the level of personal income that they assume people receive, partly because of interest on money market funds. That increased the level of income and spending in the economy and increased the level of assumed personal savings in the economy, since we kind of knew how much consumers were spending, but we didn't realize that they had earned so much. So their savings rate actually increased. And it just increased the prospects for GDP, right? So there's been a lot of this kind of worry, hey, labor market's cooling down. We're seeing jobless claims pick up. Manufacturing is still in the toilet. Housing market is not rebounding as quickly as we want. And then all of a sudden, hey, we get this huge GDP revision that shows the economy is doing pretty well. So we've actually seen that sentiment improve lately, while inflation really has come down pretty dramatically and is close to 2% on the Fed's preferred gauge. So what does that mean? It means that if interest rates are at a restrictive level, as in slowing the economy down, the Fed needs to remove that restriction, or it risks sending the economy into recession, right? Slowing the economy down further. So think of it as an analogy. You're on the highway, you're driving your car, you're trying to get to your destination, you're driving too fast, the engine overheats, and now you need to apply some brakes, okay? Well, our engine has stopped overheating right now, and now we're falling behind getting to our destination. What do we need to do? We need to remove our foot from the brake, right? And that's what the Fed is trying to do.
Definitely. I actually missed that revision to the GDP. I didn't see that. So that's actually really good, insightful.
That was huge. Huge.
Yeah. Yeah. But that sparks a question for me. So I guess who goes back and says, okay, we incorrectly reported this, or there's new data out, and they're check. I know there's like the NBER and all of these different economic groups. Can you talk a little bit more about like who is going back to make these revisions? How often are they incorrectly reported in the first place, and we see these revisions? Because I know it's like been a big topic.
It's the Bureau of Economic Analysis. They're the economic agency that puts together the estimates for GDP, for personal income, personal consumption expenditures, all of that. As far as like, them putting out inaccurate information, I mean, there's only one thing that we know about a forecast, and that it's wrong, right? And so like, think about what these people are trying to do. I mean, GDP, do you know what our annual GDP is, like the number?
I could have a guess, but I don't want to guess. You guess.
20 trillion. But like, think about like how many industries and businesses and consumers and everything that they have to compile this data for, that they do using, survey and sample statistics, right? Where they're gathering data from maybe 8,000 businesses that's supposed to represent 100,000 businesses. And so, as time goes on, they only have so much data. But then as the year passes, right, and the months pass, they have actual like hard data like receipts that they can accumulate and aggregate and create a better estimate for GDP. And they do this on an annual basis. And they do it for, the jobs numbers, which I believe is put out by the Bureau of Labor Statistics, right? They had a big downward revision annually. I think it was close to 900,000 jobs. And so this is a typical, normal circumstance for economic data. It's just nice whenever it swings in the positive direction.
Yes.
Great. Well, hey, let's move on and talk about what this means for the listeners, right? So a lot of people ask us, okay, the Fed's cutting rates. Like, what does this mean? Does this mean my rate on my money market's going to go down now? Does this mean my rate on a mortgage is going to go down? And the answer is yes, but it's a little more complicated than that, right? So let's talk about the rates that you can expect on a money market. So I have a chart here that's showing kind of a few different interest rates, right? 3 different interest rates. It's showing the Fed funds rate, which we've talked about. It's showing the 3-month Treasury rate and the 6-month Treasury rate. The reason why I'm showing these is because these are short-term interest rates, short-term securities that you would typically own in a money market fund. And so what we're seeing is very interesting. These rates were around 5.25 to 5.5, basically since October of last year, right up until about July. And then in July, we see them really take a tumble lower. And that's because that was around the time the market came around to this idea that the Fed is going to have to start cutting interest rates soon. They're going to need to start this cutting cycle. And what's interesting is you see these rates dive all the way, below 4.5% for the 6-month Treasury, at about 4.75% for the 3-month Treasury, well before the Fed funds rate even changes, right? And this is what we see in a lot of different markets, is that market participants are aware of some of these changes that are coming. And so they'll price in and anticipate this happening. And so you'll often see prices move well before the official act that's causing those prices to move. And so that's what we've seen in short-term Treasury rates, which means that's what we're going to see in money market funds. And because money market funds have very low maturities, very short maturities, they should reprice lower pretty quickly. So get ready for lower yields on your money market funds.
That's a great point, Jeff. One of the things that I didn't really understand when I first got into the industry, and as I got a better understanding of fixed income, was that the bond market is also a market, just like the stock market is a market. And so let's say you're looking at Coca-Cola and you hear that there's some issue with one of their ingredients, and that report comes out. That information is going to get priced into the stock of Coca-Cola, and it's going to trade down as soon as the markets are open. Even when they're not open, after hours closing, it's going to affect the price. The bond market's the same way. When the Federal Reserve comes out and says, okay, we're going to be decreasing interest rates, all of these bonds and mortgages and all of these different rates, they're going to move ahead of the time. They're not waiting for this point when it actually cuts. They're listening to these expectations, listening to Jerome Powell and the Fed talk, and looking at what is happening in the economy as well. Because if the economy looks strong, then that's better chance that the Federal Reserve comes in and is more willing to cut rates, or actually vice versa. So,
right, we're trying to put ourselves in the Fed's shoes here, right? And understand, hey, we know what the Fed wants. We understand the language the Fed is using and how that language is changing over time. So we can pretty much assess kind of the direction of travel here, right? And that's really what the market does. This reminds me of a phrase that's quoted often in financial markets: buy the rumor, sell the news, right? And that's because, markets are really all about, pricing in something before it happens. And then, by the time you see it in the Wall Street Journal, it's too late, right? That's what they say.
My favorite saying is just hold the whole way through. I don't like this buy sell action in between,
Hodl? Is it hold on for dear life? Is that what you're saying?
Hodl.
Arish got those diamond
we were
hands.
We were at the Future Proof conference and they were giving out hodl hats. I was like, all right. Jamie was all over it. He wanted one.
I bet. Yeah. I mean, that's a common thing in the crypto community, right?
Oh yeah.
So, I mean, they got to be used to
volatility. I was more just saying it for non-market timing.
Yeah. Okay.
I feel like people can use that and be like, all right, I want to get in now and get out then. But definitely you can be smart about how you're allocating across the board. But
yeah, definitely recommend holding long term. But yeah, I mean, I think it's great points on the bond market and how it really is a market. It's a market full of participants that are trying to achieve their own individual goals, right? I mean, it sounds a lot like a capitalistic market and conditions of supply and demand, and that's really what markets are.
Definitely. Well, always appreciate your insights, Jeff. So I guess concluding, started the episode off on comparing different asset classes and how they get taxed. And then we talked about what the impacts are of this latest rate cut and what we're seeing going forward. But appreciate you tuning in as always. I would definitely say if you haven't checked out our YouTube, this is a fantastic episode to do so. One, because you'll probably see my screen freeze like 10 times, but two, because you'll see these awesome charts that we alluded to kind of throughout. So appreciate the time, Jeff.
Yeah, thanks for having me.
And give me a good horror movie rec once you get around to that time, because there's not many out there,
Good horror. I mean, Texas Chainsaw Massacre has to be like one of the better ones. I'm also a big fan of the Saw movies. I don't know about you, but I think those are top notch.
They're fun watches for sure. Well, appreciate it, Jeff. I'll see you.
All information provided by this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third party's views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside of Beam Wealth Advisors, DBA Benedetti Gooser and Associates. All examples are hypothetical and for illustrative purposes only. Beam Wealth Advisors, DBA Benedetti Gooser and Associates does not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.